Let's continue with our S Corporation tax general concepts problems. All right, problem 4. We have Berry Corp, which has a valid S election in effect for several years. Goji owns 40% of the stock. Huckle, Juniper, Rasp, and Straw each own 15% of the stock. All shareholders are U.S. resident citizen individuals. So A, how can Berry Corp revoke its S election for the current year? All right, so to revoke the S Corporation election, and let's assume that this is the beginning, right? This is on January 1st, the current year. Let's assume they're a calendar year, okay? This is calendar year. So for this business, for the S election to take effect in the current year, let's assume they're a calendar year again, and we're on January 1st, then Berry Corp must make its election by March 15th of the current year. And the reason why is that 2.5 month rule. Now, another thing is that you have to have more than 50% of the owners agree to this specific election. Now, there's no form for this, but you would file a statement with the respective 1120S for the year. Okay, B, how can Berry Corp revoke its S election for the subsequent year? So similar to A, the key here, though, is with respect to the date. We can make this election anytime during the current year and up until 3/15 of the next year. Again, assuming we're calendar year and we're on 1/1 right now. And it's still the 50%, more than 50% requirement in the election and all that stuff. C, if Berry Corp revokes its election for the current year, when can Berry Corporation make a new effective subchapter S election? So if we revoke our S Corporation status, we terminate the S Corporation status. How long do we have to wait to be an S Corporation again? So this has changed over the years, but right now, the time of this video, you have to wait at least 5 years. Okay, D, suppose that in B, the revocation was filed on July 1st, 20x6 to be effective as of January 1st, 20x7, but that on September 3rd, 20x6, Goji, Huckle, Juniper, and Rasp decide they want to revoke termination of the election. Or revoke the termination election. Straw does not want to revoke the termination. Can the termination election be revoked? So this is what's going on, right? We're in the current year, all right? We'll call it year 1. Actually, let's call it year 4. I'm sorry. No, it's not year 4. It's year 6, right? Stupid of me. We're told it's 20x6, so we'll call this year 6, and we'll call this year 7. All right, well, the election is made on July 1st of year 6 to take effect year 7. So we've got this period in between where, hey, a revocation of a termination can occur. Now, on September 3rd of year 6, some of the owners, they say, hey, we changed our minds. We don't want to do this. We don't want to terminate S Corporation. We don't want to be a C Corporation. We still want to remain an S. So remember, when the termination occurred, more than 50% of the owners had to agree. So what are the rules rules for revoking the termination on 9/3 to make sure that it won't switch over to a C Corporation, it'll stay S? Well, you need all owners that agreed to revoke or terminate the S Corporation. You need all of them to agree to terminate this, and any new owners. Now, we're not told about any new owners in this problem, but we still are told that we have Goji, Huckle, Juniper, and Rasp, and also Straw. Now, we're not told who voted when the original decision was voted on July 1st for revocation of the S Corporation election, but the key is that we know that Straw does not want to revoke. So let's assume that Straw did vote to terminate the S Corporation election. Well, unfortunately, we do not meet the requirements, and guess what? We're bound to revoke the S Corporation status. We are bound to revoke that, okay? So that would happen. The S Corporation would indeed switch over, or would cancel, or it would terminate its S Corporation status because Straw is not on board. All right, let's go to problem 5. So in problem 5, we've got Pulp Fiction Corp. It rents movies and video games online to customers in the U.S. Pulp Fiction elected S Corporation status for its first year of operation. Pulp Fiction Corp's common stock is owned by Orange 100 shares and Grapefruit 50 shares. All shareholders are U.S. resident citizen individuals. During the current year, Pulp Fiction Corp had the following income and expenses. We've got some items of income, some expenditures and losses. How should Pulp Fiction Corp, Orange, and Grapefruit report these items? So again, when you first look at a S corporation, think of it like a partnership because it is a flow through. There are some more similarities to C corporations than partnerships, but there's many more similarities to partnerships than C corporations with respect to S corporations. So what we're doing here is we're going through all these items of income, expenditures, and losses, and we're going to break them down for Schedule K purposes in page 1 of the 1120 as bottom line, separately stated, and then non-taxable, just like we did for partnership purposes when we went through the partnership problems. Okay, so let's go through all these items, and it's the same logic. If it needs to be separately stated, same logic as it would be for a partnership, but you might have some differences. We'll talk about those. So the first is rental receipts. Remember that bottom line is we lump together the ordinary income or loss. Okay, we can lump them together. So rental receipts, can we lump those together? Yes. The general rule for ordinary income is we lump that into the bottom line. What about tax-exempt interest? So tax-exempt interest would be a non-taxable item, right, because it's going to affect the basis but doesn't get taxed. It does go on the Schedule K for the S corporation and the K1 for the specific shareholder. The gain from the sale of building, which is Section 1231, that's, of course, separately stated. Short-term capital gain, all capital gains in 1231 are always separately stated. Let's go to the expenditures and losses. Salaries. Salaries are always going to be, for an S corporation, considered bottom line, okay, because they're a normal business deduction. Equipment expenses under Section 179. So this is going to be separately stated. Remember, separately stated means it can make a difference depending on the taxpayer. Specifically here, Section 179 is determined, it's a limitation based on each taxpayer. Depreciation. So this is an interesting one. We saw in the partnership discussion, the problem, that depreciation created a separately stated item when we had declining balance. Well, here, notice there's nothing. That's because depreciation is always going to be bottom line. The reason why, well, think why it was separately stated for partnership purposes. It's because a C corporation could own a partnership and we'd have to report the distinction between straight line depreciation and double decline balance. But for an S corporation, is that ever an issue? No. Why not? Well, maybe you should pause the video and think about it. But the answer is because a C corporation can never own an S corporation. Remember the 4 requirements. You can't have an entity own an S corporation. So that's why depreciation is always going to be bottom line ordinary income. Same with rent. Always going to be bottom line ordinary income. Interest expense is a little tricky. You got to look at what the loan deals with. So this is another purchase of equipment, which actually deals with the business. Okay, so business activity. So this is going to be bottom line. Now, one thing to note is Section 163J. Yes, that's a limitation and it might apply here, but it's applied at the business level. Now, if this interest expense was on, I don't know, some portfolio activity by this specific corporation, then it would be separately stated because for the taxpayer, investment interest expense is limited to investment interest income based on the taxpayer. The next one is long-term capital loss. Capital losses are always separately stated because of capital loss and capital gain limitations. And lobbying expenses are always non-deductible. So we have our breakdown. So on the schedule, on the Form 1120, right, on page 1, we're going to lump together the bottom line. So you have 198,000 here. We've got 62,000, which is a subtraction. We've got 9,000, a subtraction. We've got 40,000, a subtraction, and we've got 12,000 subtraction. If we calculate that, what you get is $75,000 reported by the S corporation. Now, each separately stated item gets reported on Schedule K as that respective item in the non-taxable items. So that's how the corporation reported on its page 1 for the bottom line and on its Schedule K for those items. But what about the respective owners, Orange and Grapefruit? So for Orange, okay, the bottom line, this is going to go on their K1. So line 1 is going to be the bottom line, ordinary income. For Orange, we're going to have the $75,000 reported by the entity. We're going to multiply that by the 100 shares owned by Orange over the total, which is 150. Okay? and that gives us $50,000. So orange is going to report $50,000 on line 1, and grapefruit, we do the same calculation, $75,000, but now grapefruit owns 50 over 150, and it's the other $25,000, and we report that on line 1. For all of the other items, and I'm just going to show you an example, all the separately stated non-taxable, what we're going to do, let's just take the 1231 gain of $36,000. Okay, $36,000. So we'd report that 1 over 150 for orange, which that equals 2/3. So that's $24K for orange. And then for grapefruit, it's going to be 1/3 of that, which is $12K for grapefruit. Okay? So we report that portion, and that's what we do. And we do that for all the separately stated items. We give the portion to each, and the non-taxable items. All right. So now let's go to problem 6, and we'll be done with our problems. So in problem 6, we've got Dried Fruit Corp. Has a valid S Corp election in effect at all times since incorporation. So it never was a C corporation, making it easier on the built-in gains tax and the sting taxes. The Dried Fruit Corp stock is owned 1/3 by Raisin and 2/3 by Prune. All shareholders are U.S. resident citizen individuals. At the beginning of the current year, Raisin's basis in his shares was $6,000 and Prune's basis in her shares was $2,000. During the current year, Dried Fruit Corp earned $36,000 of net income. Raisin's share was $12,000, of course, because that is 1/3, and Prune's share was $24,000 because 2/3. So that's how you would allocate that if you had to calculate it. What are the results to Dried Fruit Corp, Raisin, and Prune, which I'm going to abbreviate, just Corp, R, and P, in the following alternative situations? So in A, on July 1st, Dried Fruit Corp distributed $16,000 cash to Raisin and $32,000 cash to Prune. So let's do A first. So in A, right, we've got the corporation. We've got R, and we have P. So on a cash distribution, there's really no consequences to the corporation other than reporting, okay, on line 1, this net income of $36,000, and it flows to the K1 of R and P. So for corporation, nothing. So for R, we start with the adjusted basis given to us in the problem, which we're told R's basis is $6,000 and P's basis is $2,000. So we start with those numbers. So $6,000 for R, and for P, it's going to be, which is given to us as $2,000. We then are going to increase first for the shares of income given to us in the problem. R share is $12,000, right, Raisin, and P share is $24,000. So that's our new basis before distributions. So that's $18,000 for R, and that's $26,000 for P. Okay, so Raisin gets $16,000 and Prune gets $32,000, right? R and P. So that's the key, is that you do this before you take into account the distribution. We always increase. Even though the distribution happens on July 1st, and for S corporations, we assume all distributions take place at the end of the year after adjusting for income or subtracting away for deductions to adjust the basis. So the distribution, right, R gets a $16,000 distribution, which leaves a basis of 2, right? That's the remaining basis. Actually, let me take that off. So that leaves 2,000 positive. And then P, we're going to subtract away 32,000, and that gives us negative $6,000. Okay, well, do any of them have gain? Yes. P has a $6,000 gain, which brings the basis to 0. Okay, because you can't have negative basis. So P is going to have a $6,000 gain, and the adjusted basis for P is 0. R's basis, there's no negative here. So R's basis in the stock going forward is 2,000, and P's basis is 0, and P has a $6,000 gain. That gain is going to be a capital gain. Okay, that's capital gain. Long term if held for more than a year, short term if a year or less, the stock. Okay, let's look at B. So in B, we have a similar situation. Okay, but there's one major difference. So the corporation, R and P. Okay, just like before. Now, on December 31st, Dried Fruit Corp distributes Grape Baker, which is real property, having fair market value of $12,000, basis of 8, to Raisin, and Plum Maker, having a fair market value of $24 and a basis of $22, to Prune. Okay, So this is where S corporations are more similar to C corporations when you're looking at distributions, because to the corporation, anytime you have property that has appreciated in value, okay, then you're going to take into account these items. Now, both of the and you're going to look into and record the gain, which is going to flow through to the owners. And you do this first, because if you do it out of order, it's going to affect things. So notice the fair market values are more than the bases, which means it's appreciated. So what we're going to do, remember this rule for C corporations. The corporation is going to calculate this amount realized minus adjusted basis. The amount realized is going to be equal to the greater of fair market value or any liability relief. Now, there's two specific assets here. There's no liability, so we're going to use fair market value. So we take the $12,000 for Grape Acre, that's here, $12,000 for Grape Acre, and $24,000 for Prune Acre, or Plum Acre, I should say, my apologies. And we add those two together, and our amount realized, which is the fair market value of both together, that equals $36,000. Okay, that's $36,000. So we add those two together. We subtract away the basis of both items added together, which is 22 plus 8, which is $30,000. So we get an $8,000 gain the corporation has to recognize. Now that gets distributed out to the owners, and let's say that the property to Grape Acre and Plum Acre is section 1231, so it would flow on the K1 to the owners. Now we know that Raisin is a 1/3 owner, and we know that Prune is a 2/3 owner. So what we're going to do is we're going to allocate $8,000, right? 1/3 and 2/3. Okay? Make sure I calculated everything here correctly. Yeah, we got $36,000. So 1/3 and 2/3, right? That's how we allocate this. My apologies. See, this is a simple mistake by me, and this happens a lot, right? When you got all these numbers going on. I obviously jumped the gun. And this is a lot easier than I made it out, right? I made this problem so that the numbers work out pretty easy. It's 6,000. My apologies. You're probably yelling at me on the screen. Hey, you did this calculation wrong. What are you doing? Where'd you get 8,000? My apologies. It's $6,000. So now it's easy. 1/3 of 6,000, of course, is 2,000 to R, and 2/3, of course, is 4,000 to P. Okay, so now we go through and we calculate what we did before, right? For R and P, we start with the adjusted basis. So those $2,000 and $4,000, the $6,000 of gain, yes, it gets reported on 1120, but it flows over to the respective owners. So we got the adjusted basis, R and P, starting out in the problem, and this is going back to the original, is 6,000 and 2,000. So we're going to increase for the share of income, and we're going to increase for the gain we just recorded. So the income, again, is 12,000 and 24,000. That's given to us in the problem. And the gain we just calculated is 2 and 4. So we add these together. This equals 20,000. That's our new basis. And this is going to, before the distribution, and this is going to be equal to 30. Okay, so now each R and P are each receiving land. And that equals a distribution, so we have to take that into account. So this is our new adjusted basis before distribution, so I always put that line there. Now they're each getting land, right? Raisin is getting Grape Acre, and Prune is getting Plum Acre. So Raisin, you look at the fair market value, right? Think back to our corporate tax items. So the fair market value of Grape Acre is $12,000. So we subtract that away, and we get fair market value for the adjusted basis. So this is the adjusted basis that the item gets is $12,000. These are the adjusted bases we put in those pieces of property. And that leaves an adjusted basis to R of 8,000, and for P, the property that P is getting is worth 24,000, the fair market value, and that we subtract that away, and that leaves us with 6,000, and that's the adjusted basis in the stock left over. So again, the consequences: corporation recognizes $6,000 of gain, which that flows out to the owners as Section 1231 gain, assuming that both properties are Section 1231. 2,000 to R, 4,000 to P, which they report on their tax return, and they're subject to tax. That increases their basis along with income, which the income also goes on the K1 as well, just goes on bottom line versus the other one's 1231 separately stated. Then we take into account, we determine the basis of the items, and we get the adjusted basis of stock left over for R and P. And that leaves us with the consequences to all the parties.